Now, here with more is Stephen Helmerich, co-head of economic and market analysis at Citi in Sydney. Hey, good to have you with us. Why are people buying dollars ahead of what's tipped to show more job losses in the U.S.?
Well, as you mentioned, I think there's some expectation that maybe the Fed has done cutting interest rates. That's not a view we share, although we do think there's probably a good chance of a pause in the months ahead and perhaps no change at the June meeting. We are expecting further easings in the second half of the year down to 1.5%. And as you mentioned, we do expect payrolls numbers tonight to be particularly soft, minus 100,000 on the job front. So we don't think that it's a great time now to be buying the US dollar. We do think some further US dollar weakness expected in the months ahead.
Now, Stephen, Mark Mobius made a very bold comment yesterday. He says the dollar's completely bombed out. Do you agree?
Well, I think that's probably a language that we probably wouldn't use. But as I mentioned, we do think that you would expect to see some further weakness in the dollar as the markets move to price back in some easings in the next few months. We're expecting a low in the Fed funds rate of 1.5%. And, as also mentioned, the economic data is likely to continue to look pretty poor for a few months yet.
Let's hear some projections. Where do you see the dollar trading on the euro and yen by June?
Around June, we've got it around 160 against the euro and around the 100 level against the yen. So certainly a little bit weaker than the current levels.
Germany's releasing retail sales figures today. What will the results signal for the ECB and the euro?
Well, we're actually expecting a pretty strong number in those German retail sales, up around about 2% on the month. Some anecdotes there that things maybe not quite as bad as some of the other market expectations. So we expect the ECB easing probably a little bit later and then probably less than we had expected before, maybe 50 basis points in the second half of the year. So we are expecting, as I mentioned, a pretty good number tonight on that retail sales, which should help boost the euro.
Do you think the ECB is on track with all the moves that it's taking?
Well, I think, clearly there's still some concern about inflation being above the target band. The data's been quite mixed, and the ECB is pretty slow to the easing table. We think they'll eventually get there, but not in the next month or so.
Going back to the dollar now, Stephen, its renewed strength spurring some consolidation in commodity prices. What impact is this having on the commodity currency block, including the Aussie as well as the Norwegian krona?
Yes, well, certainly, commodity price indexes like the CRB down again last night. But yesterday afternoon, the Reserve Bank of Australia released its commodity price indexes for April, and they were up massively, up over 10% on the month in April, mainly because of the big price increases for coal and iron ore with our trade with Japan and China. So, Aussie-specific commodity prices still looking very, very strong, and we expect further gains for the Aussie on the back of that. Obviously, oil price down a bit overnight as the dollar strengthened a little. But as I mentioned, we do expect the US dollar to weaken in the next few months, and that would tend to suggest that you get a pick back up in some of those commodity prices, helping currencies like the Aussie, krona, even the Kiwi.
All right, Stephen, thanks so much for that. Stephen Helmerich of Citi.
Let's ask Richard Yatsenga, foreign exchange strategist at HSBC in Hong Kong. Thanks for joining us, Richard. First of all, what's your take on what we will see from these jobs numbers today?
Look, we're pretty confident you're going to see a better than expected number. The market's looking for down 75. We think you'll get down 50 or even less. In fact, our US number crunchers run 7 indicators to forecast payrolls, and every one of the indicators is saying something better than down 50,000. So it should help the dollar continue this rally in the short term.
But we are seeing the economy continue to lose jobs despite the 7 cuts. We've seen it in sort of the past 8 months. How long before the rate cuts really start to come forward or have positive effects on the employment market?
Well, economists will typically say that the peak period, interest rate policy affects the economy about 4 quarters later in terms of its peak impact. But of course, to the extent you cut rates and help to stabilise financial markets and help to stabilise lending and help to stabilise sentiment, it affects things from now. I think the way I'd look at this Fed rate cut cycle is it has been about the most preemptive Fed rate cut cycle we've ever seen, at least in terms of the underlying economy. And so some softer data now shouldn't be a surprise. As long as it's not disastrous, the Fed's going to keep up this pretty cautious tone, I think.
So do you feel that the 2% Fed funds rate is a destination rather than a waypoint, as it were?
Look, I think we're going lower than where we are now. I don't think anybody expects the US economy to bounce right out of this thing. In fact, the history of all credit crunches says it will take some time to work our way through this. The question really is, the two questions are, does the Fed cut a lot more? A little bit more easing is priced by markets, that's fine. And the second question is, does everybody else start to cut?
Now, the FOMC, in its announcement this week, stated, I quote, labour markets have softened further. It also said the easing that's taken place since last year should help promote growth over the time. It says, I mean, do you agree with that?
No, look, absolutely. I think it's reasonable to think if you ease by several hundred basis points in a relatively short space of time, it will have some positive effects. Of course, the other thing the Fed also spoke about is elevated inflation expectations, and this is what makes really this Fed easing cycle unique. Every other Fed easing cycle, commodity prices have been going down. At the same time as the Fed has had a growth problem, it hasn't had an inflation problem. You can't say the same about this cycle, and I think that's something else which will limit the amount of Fed easing going forward.
So how does this all play out in regards to our strategy in trading the currency?
Look, I think the dollar, weakened over the last 6 months particularly sharply, primarily because the negative news was concentrated in the US. So now it's not simply, I think, a case of making the argument about whether we get more negative news, but where that negative news comes from. If the US economy has seen most of the worst and the Fed, both through interest rates and other policy tools, has managed to contain this thing to something a bit more manageable, but you start to see Europe slow more acutely, for instance, as some of the data is starting to suggest, then euro-dollar potentially has still quite a significant correction.
Richard, I want to start with the ECB, resolute in their fight against inflation, no change in interest rates expected next week. Do we expect, though, a different slant, maybe a possible change in rhetoric in the accompanying statement?
Look, certainly possible. We did have, a better inflation, some better inflation numbers earlier this week out of Europe. The activity data has been somewhat softer. But I think the question really for markets is, does the sentiment or the tone of the statement change the framework we're using for the ECB? And as you say, that framework has been centred around this inflation focus, and I think not. I think they'll stay quite inflation focused. In the short term, that's euro positive, but as I say, the question really now is what happens to activity going forward.
And what do you think will happen to activity going forward?
Well, look, the data in Europe has taken another leg down recently. It should continue to slow, as what we've seen in the US occur forcefully in the US is occurring more slowly elsewhere, as that starts to feed through, as the credit crunch continues to affect underlying levels of activity, and that will bring the indicators in Europe down further.
The Bank of England balancing act, between the threat of faster inflation and slower growth. No change in rates forecast for next week. But where does the Bank of England go from here, and what effect is that going to have on sterling?
Well, I think the Bank of England obviously faces a much more similar situation to the Fed than, say, the situation facing the ECB, where the credit crunch has had very noticeable impacts. Of course, Northern Rock highlighted how vulnerable the UK financial system is to what's going on. And so certainly, on that front, we expect the Bank of England to continue to, at the margin, focus more on the threats to growth than the threats to inflation. So in the short term, I think the market's right. No movement from the Bank of England, but further out, there's more easing to come. On any metric, cable still looks overvalued. Sterling particularly still looks overvalued and should continue to decline.
Richard, thanks for joining us today. Richard.